Good morning. It's Thursday, April the 2nd, last day before the long weekend. And here is what's on the agenda. Donald Trump says the war in Iran is ending the end is very close, despite threatening escalation. Oil jumps and stock futures plunge, and a year after Liberation Day, the president weighs new tariffs.
Let's check in on the markets with that as the background context then, Lizzy. And we are risk-off across equity markets. Certainly if you look at US futures and European futures, down substantially, down by 2%. We were vulnerable to this, of course, because we priced in so much optimism yesterday, and then the tone from President Trump was not what the market was expecting, not what the market was positioned for. And so we see a retreat in risk assets. Brent crude goes higher, up by 6.6%, as we don't get any clarification on the Strait of Hormuz. And we're back to thinking about inflation. We're seeing selling in treasuries, selling in bond markets, yields going higher, thinking about inflation and worrying what the ongoing closure of the Strait of Hormuz means for energy prices. The countdown to the opening trade starts right now.
We're going to hit them extremely hard over the next 2 to 3 weeks. We're going to bring them back to the Stone Ages where they belong.
So a rare primetime address from President Trump, delivering nothing new really, Anna, and more of a doubling down on his escalate to de-escalate rhetoric. No endgame plan. Actually quite defensive, trying to sell this war to a sceptical American public, and crucially for our purposes, really none of the clarity that markets are craving.
Yeah, not the clarity. The market's very much focused on the escalatory nature of it. There were some lines that could have been interpreted as de-escalatory, but that's not where the market's head is at, and so we see risk off. The dollar is higher, we see stocks are down, futures, we've been through those in the US and Europe, both down, and treasuries pivoting back to concerns around inflation. If you look at what analysts have been saying about this, they're talking about how this was maximalist rhetoric, added to uncertainty, no reassurance of any de-escalation, and of course making the point once again that military assets have been building up in the region. And looking at what this has done to stocks is interesting because it plays into a pattern we've been seeing over recent weeks, that we see risk appetite actually quite positive towards the beginning of the week, Monday through Wednesday, and then declining Thursday, Friday. So we are going into a long weekend, as you pointed out, Lizzy, and that leaves investors nervous.
Yeah, polymarket odds suggest a violent end to this war. So if we look at it, you've got both US ground forces in the Middle East and a summer ceasefire priced at a high probability at the same time. And then if you also look at the stock reaction, there was a brief moment where the market thought, as it was thinking yesterday, that Trump was going to stay on message, this de-escalation message. But as soon as that militaristic rhetoric kicked in, they took a turn for the worse.
Yeah, absolutely. And you think about how assets were vulnerable to this, because we priced in something really quite different this time yesterday. We were talking about positive messaging. President Trump went on yesterday to talk about give quite a de-escalatory account of what was going to be happening, and focusing very much on the time constraints and the extent of involvement in the Strait of Hormuz being limited and all of that kind of messaging. So the market caught off guard perhaps by the tone of this. Shall we move on to commodities? Think about where we are there. Yeah. We've got near-time pricing on the rise for oil, of course. We're at 107, that's the handle on Brent, 107.95, 106.22 on WTI. So both of these, Lizzy, up by more than 6%.
Yeah, even with President Trump's 2 to 3 week timeline, investors warning that it's going to take time for oil flows to return. Nothing about the speech changed the reality that the Strait of Hormuz is essentially all but closed. And his team suggesting that reopening the strait may not be necessary to end the hostilities. Interesting comments in the FT reporting that the president threatened to stop supplying weapons for Ukraine to pressure European allies to join a coalition of the willing to reopen the strait. So oil, as you say, is up, and that is keeping central bank hike expectations elevated.
Yeah, it's interesting that in terms of coalition of the willing, there is at least a coalition of the willing to talk right now, because the UK is convening 35, I think, countries to talk about the Strait of Hormuz and what can be done from a diplomatic perspective, from an economic perspective, and then, failing that, from a military perspective. So there are conversations taking place, but all of the participants, willing to exercise those three levers to very different degrees. I was really interested in the way that the oil market specifically is responding to this very much at the coalface of it. So the very short tenor oil futures. So if we're looking at the nearest spread, looking at the prompt spread then, the two nearest contracts, and you can see that there's an $8 gap between June and July. So we are focusing very much on President Trump's timescale of 2 to 3 weeks and thinking about maximum disruption over that period and then dialing back the disruption after that.
Yes, and we should also talk about the other commodities being affected by this. Gold fell on the speech, again, because it was more of a victory parade than a ceasefire announcement. And when you look at other metals, industrial metals like copper fell on the speech, on the threat to attack Iran's civilian infrastructure in particular if the talks fail. There was a line that he said that he was going to hit Iran extremely hard in the coming weeks and bring them back to the Stone Ages where they belong. And then you've also seen the impact on aluminium, down as well, but we should note that it closed at its highest in 4 years yesterday because of that strike on the Emirates Global Aluminium and them saying that the missiles from Iran had forced one of its smelters to stop output.
Yeah, so a lot of focus on the scarring, beyond the human toll, obviously, in people's minds, but beyond that, the economic scarring to all kinds of infrastructure in the region. Let's talk about what's happening on trade. Something else to think about, because in case you hadn't noticed, it's the 2nd of April. Where were we? 2nd of April last year. We were right here talking about Liberation Day, as it was dubbed by the president, and talking about the impact of that on global trade. So we have a reminder of this story, and it hasn't fully gone away. We've been waiting for the results of a Section 232 investigation into the pharmaceuticals industry, and now we are reporting, lots of places reporting, that we could get, as soon as today, pharmaceutical companies being hit with a 100% tariff. Crucially, there are lots of companies that have already done deals and countries that have done deals with President Trump, which means they'd be excluded. But it is a nice reminder of, how far we've travelled and also how far we have not travelled since April the 2nd, 2025.
So 100 to 200% on pharma. Also, the Trump administration reportedly preparing to outline a tiered system for steel and aluminium tariffs to try to simplify the current system. So we could get an announcement again on that as soon as today. And the Journal reporting that that could be a 25% levy on finished goods that are made with imported steel and aluminium. But as we reflect on the economic impact of tariffs so far, we have a great piece about this on the Terminal. And that deep blow to growth that many had feared hasn't really materialised. You have seen global trade holding up, and because of the trade deals struck around the globe, that's softened the blow. Yeah, absolutely. Many reasons why the blow has not been as tough as we thought it might have been. Plenty of carve-outs, some doubling down, some taco in there as well. But if we look at the effective, and we just had a chart up actually, of the effective tariff rate on imports into the United States, you can look at it two ways. You can say it's 4 times what it was before Liberation Day. So that is clearly going to be negative for global trade. But on the other hand, it's well off its highs that it was a year ago. So, there are different lenses you can apply to looking at that tariff story. We'll continue to revisit that as we go through the programme. Let us tell you some of the other guest conversations we have coming up this morning. We will talk about FX. The dollar is gaining, as you would expect, because we are risk off this morning. Alex Yekov will be with us, BNP Paribas Markets 360. G10 FX strategy head for Europe. I've seen some interesting calls on the yen and the pound in the context of the risk-off story around Iran. Frederic Carrier will be with us, RBC Wealth Management Investment Strategy UK and Asia head. And we will also find time to talk about the travel industry. This, of course, an industry that has been hugely disrupted by what is taking place in the Middle East. Irene Hayes joins us. Hayes Travel, really big tour operator here in the UK. What is the perspective on the ground about where people are and are not flying? Let's take a look at what else we're watching throughout the day. At 10 a.m. London time, we have Italian retail sales data. We have the French President Emmanuel Macron visiting South Korea. He's expected to arrive at 10:30 a.m. London time. At 1:30 p.m, we have US jobless claims data. At 2 p.m, Tesla sales numbers. That's in the US pre-market. And later on, we'll be hearing from the Fed's Laurie Logan. OK, so those are the things on the agenda. Let's get an update on the other stories that we're focused on this morning. A bit of corporate news for you. Bloomberg understands that the beauty giants Estee Lauder and Puig are advancing talks to combine. Sources say the deal to bring together the two family-owned companies would be mostly stock with a formal announcement possible within weeks. The tie-up would create one of the world's largest luxury beauty companies and pose a significant challenge to the French cosmetics giant L'Oréal.
The Iran war prompted a record surge in the price of petrol and diesel in the UK last month. The unprecedented price rise is adding pressure on Keir Starmer, the Prime Minister, to step in to help motorists. Yesterday, Starmer acknowledged the rising cost of energy, but stopped short of announcing any major new support. And NASA's Artemis 2 mission has launched to space and reached a stable orbit, kicking off a landmark journey that will take the crew of astronauts closer to the lunar surface than anyone has been in more than 50 years. The rocket system, taller than the Statue of Liberty, reached speeds of more than 17,000 miles per hour as it hurtled into space. The crew will spend roughly 4 days travelling to the lunar vicinity, where they will swing behind the moon's far side. They are slated to perform a flyby of the lunar surface on April the 6th. So out of communications for a period of the flight, just as they were decades ago in similar test flights. So certainly something we'll continue to monitor, Lizzy.
Well, coming up on the opening trade, the challenges are mounting for the global aviation sector, with soaring jet fuel prices, airspace closures and widespread flight cancellations. We will discuss the outlook as the Iran war drags on. Plus, we'll look at the stocks to watch at the open, including Novo Nordisk. This after Eli Lilly's weight loss pill wins US approval, ratcheting up pressure in the battle to lead the obesity drug market. But up next, we'll be joined by Willem Sells, Global CIO at HSBC Private Banks. If you've got any questions of your own for any of our guests, please do send them in to us on IB plus BB TV Go. Good morning from London. This is Bloomberg.
When this conflict is over, the strait will open up naturally. It'll just open up naturally. They're going to want to be able to sell oil because that's all they have to try and rebuild. It will resume the flowing and the gas prices will rapidly come back down. Stock prices will rapidly go back up. They haven't come down very much, frankly.
President Trump used his primetime address on the Iran war to say the conflict is very close to completion, but he also warned the US plans to launch fresh attacks within the next 2 to 3 weeks. It is on that latter line that the market seems to have focused. Let's bring in Bloomberg's Washington Deputy Bureau Chief Laura Davison, who is able to take us through the key takeaways, Laura, then, from what we heard from the President. Good morning. What were your thoughts?
Much to the market's dismay, there wasn't a lot of new information in this speech. This was largely a rehash of things that he has said previously. There was a lot of optimism that there may be additional clarity in this address, calling all the TV networks and everyone together for this primetime speech to lay out, what those next 2 to 3 weeks look like. Instead, he kind of even backed away of some prior comments where he had indicated that the war would end in 2 to 3 weeks. Now he's just promising fresh attacks. He says talks are ongoing, but it's unclear exactly what those look like, and really didn't give any of the indications that people were hoping to see. One thing was clear, however, is that the Strait of Hormuz and what happens to it, how to open it up, is something that he is leaving completely to allies. He sort of lambasted European and Asian allies, saying that they needed to buck up and get some courage and take over that strait because it wasn't the US's problem anymore. So that's why we're seeing a meeting today happen. Keir Starmer's gathering 35 leaders from around the world to talk about that next step. But this is, something, at least an objective that, was a priority for Trump just a couple weeks ago that he's now completely abandoned.
So what are the main unknowns that we are waiting for clarity on now? Because there's been so much mixed messaging since the war broke out.
Yeah, we still didn't get any additional clarity about, what sort of talks he is willing to pursue with Iran, who the administration is talking to. They have, continued to maintain that they're having direct and indirect talks with top Iranian officials, and the officials at Iran have continued to deny that. There's also not any clarity about, if there will be, beyond those 2 to 3 weeks, an escalation in military might. There are still U.S. troops in the region, and, kind of what Trump's overall plan here, and if he, is he going to end this war here in just a couple weeks, or is this going to be a long-term protracted fight? All of that remains unclear, adding to the uncertainty that we're really seeing play out in the markets today.
OK, Laura, thank you very much for the update. That's Bloomberg's Laura Davison. Now, rather than reassuring markets that he could bring an end to this war swiftly, some of President Trump's remarks appeared to have rattled investors. Joining us now to discuss is Willem Sells, Global CIO at HSBC Private Bank and Premier Wealth. Good to have you with us this morning, Willem. I wonder how risky President Trump's escalate to de-escalate rhetoric is, this strategy, if you want to call it that, for markets. Are markets bearish enough at this point? How are you bracing for the next 2 to 3 weeks or more of this war?
So it's very difficult for investors to trade this, right? You have ups and downs, maybe even during the day, but certainly from one day to another. We don't, if there is further escalation, then obviously the fear of the market will be, number one, do we have further harm to production facilities and refineries? But more importantly, when are we going to open the Strait of Hormuz? So it is that transportation, that flow that is important. My understanding is that if you want actually a convoy, you will need quite a broad coalition from that London meeting, especially if the US is not participating. So that is what the market finds difficult. So everything remains about oil and energy prices and gas prices. So that has an impact on the producers versus the consumers. So a lot of Asian countries, being hurt by that. Europe underperforming versus the US. The US dollar strengthening on the back of that. And so therefore, sort of that diversification that we saw over the last, number of months away from the US dollar, that being stalled. That then has an impact on the treasury market, and together with the US dollar being strong, obviously holds gold back. But I think the sell-off in gold is probably done.
OK, that's interesting, because gold obviously hasn't been the best performing hedge throughout all of this. When does the turnaround, what prompts that turnaround that makes you say it's done?
So, we work a lot with scenarios for our clients, right? So, a solution to the war, a reopening of the Strait of Hormuz, being the positive scenario, that then obviously brings down the US dollar, and you get, again, that diversification, that demand for gold coming back. So the positive scenario for the world is positive for gold as well. The worst scenario, where it all continues to, the Strait of Hormuz continues to be closed, that is a negative for gold. Why? Because you get continued pressure on treasury yields and on an upside on the US dollar. So maybe a little bit further downside in that scenario, but ultimately there is support. So in most of the scenarios work well for clients, because they do stress test of their portfolio and they kind of sense whether they're comfortable under different regimes. Clearly, we use our quantitative strategies on that as well, our quantitative models, to give them that comfort. But most of them are looking for diversification and are not panicking at this point.
OK, not panicking. Are you panicking about volatility in bond markets, Willem? Give us some context around the amount of volatility we see. It passes almost unmentioned that we see, the scale of the moves that we're seeing right now, because it seems to be almost daily. We've got US Treasury yields, 10-year, 6 basis points higher today. I'm just looking at the start of the European trading day, and we're up by 9 basis points over on the Italian BTP, 7 in France. We're back to worrying about inflation once again. This is a fast-moving agenda for the bond world.
Yes, I do think that you have two-way volatility in the bond market as well, and that then obviously leads to opportunities for those people who are not panicking but want to tactically,
yes,
use those opportunities. So obviously structured product being, one of those areas for private banks. From a bond market perspective, I do think that you are starting to see more of a two-way move on the back of, number one, inflation concerns, but then how is that going to impact growth, and do we have a flight to quality as well? So you're starting to have more of a balance, I think, between those two. Clearly, the Japanese auction was one of the elements, today, also the oil price move. But I do think that, people, they tend to, however, shorten their duration. Most of our clients were already somewhat short in terms of duration, so that's a bit of a trade. They obviously are also in quality in the credit space.
Yeah.
Although you must say that, from an emerging market perspective or from a credit perspective, the widening of credit spread has been relatively orderly, and that gives us some confidence as well.
You mentioned emerging markets there. Just wanted to focus in on some of the changes you've made to your strategy as a result of all of this. And one of the things is downgrading Indian bonds, equities and the currency. There's been a lot of euphoria around India. So is this just part of dialing back exposure to areas that have done really well in recent years?
It's areas that have done really well, but also the ones that are sensitive to oil and energy prices generally.
So within suffer in terms of trade.
So within Asia, clearly the more vulnerable in terms of oil prices are Thailand, Indonesia, South Korea, and Taiwan. Now, from a longer-term perspective, we do think that South Korea and Taiwan have that upside from an AI perspective, exports as well to the rest of the world, and that's a longer-term trend that continues to be there. So I think the sell-off in those countries was kind of a little bit of profit-taking, as you were saying, because those markets had done very well. But so they have that upside, those two markets, whereas in India and in Indonesia, I think, have less upside, for the rest of the year and are currently vulnerable to those oil imports.
Does the AI story give you fundamental faith in the US economy and its resilience?
I do think so. And especially if you are thinking about a world, once this conflict is solved, a world where we will have somewhat higher inflation than a central bank's policy stance, but not necessarily interest rate tightening. Plus, you have economic growth that is kind of lackluster. What you then want is quality earnings. And clearly, technology, obviously the profitable technology companies are a good place to be, given the weight of that sector in the US. That is an area, where we think, one of the reasons why we continue to be overweight on the US, which is, I think, which certainly was out of consensus, but with the conflict, maybe somewhat less consensus.
Yeah. Willem, I see a lot of references to fog recently, the fog of war and therefore the fog of investment, really, the difficulty with having conviction. We've seen the Fed be very open about the fact they don't have a huge amount of conviction about where things go from here. Can we have any framework for understanding where the Fed goes and how much that's going to matter and cut through to markets? So
relative to other central banks, obviously the Fed has the dual mandate. So therefore we do think that there is, in a bad scenario around the conflict where it continues, I think the ECB or the Bank of England are much more likely to hike interest rates than the Fed would do. Because the European banks, central banks, kind of more look more at the inflation side, whereas the Fed has the dual mandate as well, looking at growth. So they will have a negative impact on growth, and therefore, we think that the Fed will be stable. Now, that is one of the saving graces for the emerging markets, to make it not too bad for the emerging markets risk appetite. And I think that is one of the reasons why, indeed, that credit market, emerging market credit, has continued to be reasonably benign, because the core view is still that the Fed won't hike.
But very briefly, I mean, you've turned cautious on consumers. How fast do higher energy costs start to bite into demand and even earnings?
Already, right? They already see the impact on inflation. Now, one thing compared to 22, because there is lots of people comparing to the 70s and then 22 being closer. We have not yet, the gas price spike for the moment is smaller than 22. We don't yet have a food price spike, yet we have inflation pressure. But the negative for the consumer is that the labor market is weaker than in 2022. So it won't necessarily feed through into a big inflation spike, but the consumer, nevertheless, is stretched.
Yes, and the unemployment point, crucial one. Willem, thank you very much. Thank you for your time. Willem Sells, Global CIO at HSBC Private Bank and Premier Wealth. Coming up, we will continue to focus on the market's response to President Trump's speech. The dollar edging higher this morning as President Trump says the US will hit Iran extremely hard. We will talk to Alex Yekov, head of G10 FX Strategy Europe at BNP Paribas Markets 360. This is Playbook. Welcome back. 30 minutes from the start of the cash equity trading session for stocks, and the final trading day of the week, of course, Thursday, 2nd of April. So this is the futures picture. We are expecting to see substantial retreat in risk appetite at the start of the trading day today. So Euro Stoxx 50 futures down by just shy of 2%. All of this, of course, coming off the back of President Trump's speech that he gave some hours ago now, and the market has taken a negative reading of what he had to say, not adding a huge amount new, Lizzy, but certainly emphasis on the escalation, the re-escalation potential within the next 2 to 3 weeks.
Yeah, we're seeing that risk-off flavour in the bond space as well. Yields climbing higher across the continent, across the European curve, and following moves in treasuries. So the 2-year Treasury yield is up 5 basis points. But I should say that this is more at the front end here in Europe. So Spanish and Italian bond yields are up at the front end by 9 basis points for BTPs and 8 in Spain.
Let me just detour slightly to talk about what's going on in Switzerland, because we are hyper alert to anything to do with inflation right now, because we have expectations of rising inflation. The market expected inflation in Switzerland to take a tick up, and in fact the market expected it to be higher than it has come in. So that's perhaps worth noting, because Euro Swissy is on the move as a result. So the March consumer prices number for month on month up 0.2%, and the expectation was for a rise of 0.5%. And similarly, the year-on-year number is up by 0.3%, and we'd expected 0.5% higher. So we will continue to watch this, and we're going to have a conversation about FX markets shortly. So perhaps this will be something that we will focus in on in a moment. Lizzy, let's talk for the time being about some of the developments in the Middle East.
Yeah, let's turn back to the geopolitics. US allies preparing a diplomatic push to reopen the Strait of Hormuz while weighing sanctions if Iran keeps the key waterway closed. British Foreign Secretary Yvette Cooper will chair a virtual meeting today with counterparts from some 35 countries. And Paul Wallace, our managing editor for the Middle East and Africa, joins us now around the desk. Paul, just talk us through what we know about this meeting.
So this is going to be a virtual meeting chaired by Yvette Cooper, the UK Foreign Secretary. It's got 35 countries there. Most of them are European countries, a couple of Gulf states, the UAE and Bahrain. Essentially, they're going to try and figure out what to do about Hormuz and how to reopen it, especially if Trump does follow through on some of the things he signaled about walking away from, moving exiting the US, as it were, even if Hormuz is still shut. Tellingly, the US is not part of this group of 35. So, in a sense, they are there to just try and find out how to get it reopened. They don't want to use force. That's sort of going to be the last option on the table. They're going to try the diplomatic route first and try some pressure tactics on Iran, such as even deeper sanctions. Important to note that Iran is already heavily sanctioned already, so that route may not work so well.
Yeah, you wonder if any of this is realistic in a conflict like this.
Yeah, so economic pressure on Iran, it's hard to see that causing the Iranian leadership to budge much. But there are plenty of countries within that group of 35 that have quite deep sort of diplomatic relations with Iran, and the hope is that at least some of them can get through to Iran's leaders and make sure that whatever happens, Hormuz is reopened and safe for commercial vessels.
Yes, and President Trump has been quite ambiguous on what he wants to see happen with the Strait of Hormuz, constructively or otherwise. What about what we heard from Iran yesterday? Because before President Trump spoke, we saw this quite astonishing letter, really, from the Iranian president to the American people. So trying to, in the words of Iran, cut through the rhetoric and look beyond the political rhetoric. What were the things that stood out to you in that letter?
From that letter, well, I mean, the fact that they wrote it and published it in English, in long form, and all those sorts of things, that's sort of significant in itself. This is not something Iran does much. It came a few hours before Trump's speech, and it really was trying to be some kind of message to the American people, I think, to do another effort by Iran to, get the Americans against this war, to up pressure on Trump to end it. Whether or not it's gained any traction, it's hard to tell at this stage. There hasn't really been any kind of significant reaction from American politicians or anything like that. But I think it does show that for all Iran's belligerence and rhetoric, that it can keep going for much longer in this war. It does want this to end. It is, day by day being exhausted by all these attacks and all these counterstrikes that it itself is making against Israel and Arab Gulf states.
Yes, and it seemed as if during the session yesterday it was interpreted as something that maybe was designed to take the tension out of the situation a little bit. We don't know if that will be successful, but that was maybe the aim, and then go some way to explain why markets were then wrong-footed overnight by what we heard from President Trump, because they'd expected or they'd been poised for something a little different. Thank you very much, Paul. Thanks for joining us. Paul Wallace, our managing editor for the Middle East and Africa. Thinking of the market market's response then yesterday and President Trump's speech overnight, European hours. The dollar is edging higher after President Trump said that the US will hit Iran extremely hard over the next 2 to 3 weeks. Alex Yakov, head of G10 FX strategy Europe at BNP Paribas Markets 360, joins us now. Alex, good morning to you. So what stops the dollar in this current environment where we have so much headline risk and, just like we saw overnight, escalation can happen pretty quickly?
Good morning, and thanks for having me on again. We think very little stops the dollar now from appreciating. Our work's shown that the dollar's actually not reacted enough to the energy price shock that we've seen. So if you compare it to past supply-related energy shocks, the dollar's only reacted with about a 50% beta. So why is that? It's basically the front-end rates repricing in energy-sensitive countries have insulated these currencies like euro and sterling. Another way of saying this is the market's been trading inflation. We think going forward, the market will pivot to trading growth, and growth is dollar positive.
So the fact that we've had expectations of rate hikes from some places because the inflation challenges they will face on imported energy, that means that the dollar... that we haven't seen so much negativity in those currencies and so not so much positivity in the dollar then.
Exactly.
Yeah, so that's the argument. And so I saw somebody this morning suggesting that the pound is the poster child for dollar strength. Where does that take us? Do you agree? Is that where you're watching?
I think it is, and it's actually where this phenomenon that we talk about is most pronounced, because sterling's been one of the least bad performing currencies since the start of the war, which is confusing and we think should correct itself for a few reasons. One is that the energy channel is quite strong in the UK. The UK is sensitive not only to higher oil prices, but also to higher gas prices. And secondly, one thing that sterling has, maybe even more so than euro, for example, is fiscal risk. So as yields rise, sterling should be more sensitive to the back end of the curve than the euro. Now, the market's already built shorts in the pound, but those shorts are not extreme, and so our view is that cable has further room to fall.
OK, so the pound particularly vulnerable. What about the euro? Because you see 75 basis points of hikes, if I'm right, from the ECB between June and September, but you're not convinced that they'll benefit the euro particularly. Does it come back to this story you're telling about the dollar, that relationship is kind of broken?
Exactly. So typically rate hikes are positive for the currency through the rates channel, but sometimes, especially during energy crises like this, the growth channel dominates. And so we don't think the 75 basis points or so of ECB hikes that could come are likely to prove euro positive. I think you can almost make a case that they'll be euro negative if it comes at a time when growth data is also turning in the eurozone. The ECB are in a difficult position insofar as they want to prevent inflation expectations from de-anchoring or rising. So they want to prevent rises like in 2022. And so they'll try and get ahead of the curve by hiking preemptively. But that's not to say it can feed through to a stronger euro. OK,
one of the potential winners that you flag, though, is the Aussie dollar. And indeed, it has been more resilient compared to Liberation Day or post-Liberation Day last year. But if this is a protracted conflict, and there's no signs from President Trump's speech, really, that it won't be, and you have global growth souring and the data turn, and they're already starting to turn for Australia, how much pressure could the currency come under?
So we already had a positive view on the Australian dollar going into this crisis. The RBA was hiking. There was a good flow story. If anything, Aussie is a relative winner rather than an absolute winner, if you will. So Australia is a net energy exporter at the margin, and the RBA is likely to tighten, if you will, for good reasons, or was already tightening for good reasons, not bad reasons, as is the case in Europe. And so we think the Australian dollar has more room to go. One caveat is that you need equities to hold up. So you can have gradual declines in equity prices and the Australian dollar do well. You cannot have sharp sell-offs, 10% plus in equities, and the Australian dollar hold up.
Can I ask you about the role of the Swiss franc right now? We just got that CPI data out of Switzerland, and we're primed for signs of higher inflation, of course, because of what's happening in the Persian Gulf. But the inflation didn't come in as high as we expected. So the survey for the year-on-year and month-on-month was 0.5% higher. And in fact, we got 0.2% or 0.3% on the year-on-year figure. I mean, do we make much of that miss, if that's the right word for it, on inflation? What do we think? I mean, the questions around the Swiss National Bank had all been about whether they were going to have to go back into negative territory again, and the haven status of the currency. How are you approaching the Swiss franc?
So let me touch on the haven status point there, Anna, because yen stopped being a reliable safe haven a while ago. Gold is obviously not a reliable safe haven, so Swiss was sort of the last thing left for markets. And now even Swiss isn't performing in this latest bout of risk-off and higher geopolitical risk. We think ultimately it will. The dovish S&B is now priced after the meeting, and we've had a decent repricing in Euro-Swiss higher. It is one of the few places that the market can still hide in the geopolitical risk-off, and we would argue that local factors become less important in times like this for Swiss than global factors. So ultimately, we would be minded to say the move higher in Euro-Swiss looks overdone.
And let's talk about the yen then, because if oil prices get towards $150 a barrel, as some are expecting, we're only at 108 only on Brent today, how much further could the yen slide? Because you've got Japanese officials ramping up the intervention rhetoric. UBS flagging dollar yen could reach 175.
So for dollar yen, we've had a view that the energy crisis is bullish. In other words, that higher energy prices will filter through to the yen, again, via the growth channel, rather than that yen will be a reliable risk-off hedge. And that view has proved, at least so far, correct as we've ground towards 160. I think if we continue to see higher oil prices, then so too will dollar yen grind higher. But again, a bit like what I was saying earlier on the Australian dollar, it depends on how far the sell-off in equities goes. If you get a very sharp, deep sell-off in US equities, it's going to be difficult for dollar yen to sustain the grind higher. The BRJ here also become an important element. We think they can hike in April. That should be, all else equal, positive for the currency. But maybe to some extent it's even linked to the currency, where they're more likely to hike as dollar yen goes higher now.
Alex, can I take us back to where we started the conversation, which was on the dollar? Because you were clear, you don't think much stops the dollar in the short term. Things look poised for more dollar strength. We see dollar strength this morning up by 0.4% on the dollar index and Bloomberg dollar index. If we take a longer term look, though, how do you think we think about the de-dollarization narrative and the threats to the dollar dominance from the yuan, the euro, or from wherever? How do we think of that in the context of what we're seeing in the Middle East? Is it too soon to say? Can we draw any conclusions?
I think it's too soon to say. So throughout last year, we had a view that the flow story was negative for the dollar, driven by higher European investor hedge ratios. This year, that story is, of course, less prominent. I think one really important angle to watch when the war ends is how European equities perform relative to US equities, because this is an important determinant when it comes to Eurozone investor flows. So if we start to see European equities outperform again, then potentially we can see a more negative dollar flow story. I think for now it's too soon to draw conclusions, and definitely too soon for the market to trade this as a theme. And how much does it matter what the Fed does? Are you expecting it to be more likely that Trump gets his cut this year than not? So the Fed are arguably in a better spot than the ECB or the BOE. They have the luxury of being able to wait because the inflation feed-through is less strong, or at least the impact on inflation is less strong of higher energy prices. So if tomorrow we print well in payroll, so we expect 70K and unemployment at 4.4, then they can move to a symmetrical reaction function in April, which means same chance of, or an equal chance of a hike as a cut. But I don't think you necessarily need the rates channel for the dollar to strengthen. So you don't need the Fed to turn more hawkish in order for the dollar to go up. You can just have energy prices at current levels filter through to growth in a negative way, and that drives a stronger dollar. Well, thoughts with everybody covering that tomorrow. Alex, good to have you with us around the desk. Alex Yakov, head of G10 FX Strategy Europe at BNP Paribas Markets 360. Well, the war in Iran has left Fed policymakers with tough decisions, as we've been discussing, as concerns grow over inflation and the global energy shock.
Policy is well positioned to address risks to both dual mandate objectives, and I expect the current setting of the policy rate will remain appropriate for some time. However, I will support adjustments in the stance of policy if the evidence indicates the economy requires them.
That was Alberto Musalem, President of the St. Louis Federal Reserve, and we'll be discussing more on the challenges ahead for central banks next. This is Bloomberg.
Welcome back, everybody. The opening trade is 12 minutes away. Cash opening trade, that is, of course, for European stocks. And we are expecting a very negative session. Yesterday was really strong, and that's part of the backstory here. Let's turn to markets in 3 minutes with Adam Linton from the Bloomberg Markets Live blog. Adam, good to see you. So give us your perspective on this sort of up again, down again market environment that we're in. Yesterday, we were talking about how there was going to be quite a lot of short covering, and that's why we bounced so hard. Markets were positioned for something de-escalatory. We didn't get it, and now we expect a drop at the start of trade.
Yeah, I think the main thing to say is this market's just been pulled in such extreme directions all the time. You know, yesterday we thought we were pricing out the tail risk of materially higher energy prices. That's why we saw that extreme bounce. Also a bit of positioning at play helping there. And then today we've now had a re-escalation. So we're kind of stuck in this kind of de-escalation versus escalation ping pong. And I think the market is just getting increasingly fatigued by that. And I think ultimately there's an increased burden of proof now for de-escalation. I think we need to kind of see actual actions and material breakthroughs. And until then, I think the market's probably going to stick to the broad playbook that we've seen throughout the conflict, which is sell stocks, sell bonds, buy the dollar and buy oil. I think, even if you do see some positive headlines today, I don't think they'll have too much cut through into the tape. We're heading into a long weekend, a lot of headline risk on that front. And therefore, I think, today's moves probably will stick.
So it's like taco just gets less and less effective the longer this goes on. When you look at the bond space, yields are up across the European curve. Is it that markets are worrying about inflation again and we're more likely to have ECB hikes?
Yeah, I think, definitely the inflation angst has reasserted itself back on markets. Yesterday we did see some of this price action in the fixed income space, but it was relatively muted. We saw a bit of a fading of some of the hike expectations when things did look a little bit better. But ultimately for markets, it's a case of trying to figure out where is this landing zone for energy prices, how protracted is the crisis going to be. And, we saw yesterday remarks from ECB officials that we may already be in the ECB's adverse scenario. And, when it came to increasingly pricing rate hikes, ECB officials wanted sufficient information in order to get there. But, if things do become more positive, that kind of cuts both ways. The ECB are going to need to have sufficient information in order to be able to declare the all clear. And I think until we kind of get increased visibility, markets are going to keep pricing rate hikes from the ECB and the Bank of England. I think the Bank of England was incredibly telling. You saw Bailey come out yesterday and say markets are wrong to be pricing Bank of England hike rates. Well, ultimately, the market just shrugged at that because it's really struggling to kind of deal with this reaction function. And even if you don't think the Bank of England are going to hike, this inflation risk means that markets will continue to price that risk.
Yes, and some people pricing in hikes and then quickly cuts for different geographies. Let me ask you about non-farm payrolls. It's going to drop into a market that's basically closed. What are we going to do with this information about jobs and the extent to which they were created in the month of March? In the US?
Yeah, it depends on where you are. You'll either pick that report up Monday or Tuesday, and then between then you obviously got a lot of headline risk from Iran, so we don't necessarily know exactly what the lie of the land will be. I think if you're an equities trader, I think it's hard to call is good news or is good news bad news, vice versa. And for rates markets, we saw solid data, lead to higher rates. But if in an adverse scenario, is that good data going to have a positive story? Probably not.
Adam Linton from our Bloomberg Markets Live team, thank you very much. And remember, you can get up-to-date analysis and insight from Adam and the team by going to MLIV Go on your terminal. Well, 7 minutes away from the cash open here in Europe, we have Euro Stoxx 50 futures down 2%. Let's look at which stocks are likely to be on the move with Bloomberg's Chloe Melly. Chloe.
Good morning, Lizzy. Novo Nordisk is very much in focus today after its biggest rival, Eli Lilly, won US approval for its weight loss pill. And so this now creates greater competition for Novo, which just launched its own weight loss pill earlier this year. So as we can see here on the chart, we've seen that the performance between the two companies really go into two different directions starting from last summer. And so this is a period during which Novo saw a lot of different headwinds, including trial setbacks and some management upheaval as well. And so the the news on this US approval for Eli Lilly is potentially likely to widen that performance gap even further. Moving on to some M&A, and we have got Estee Lauder and Puig said to be in advanced talks, and so this potential deal would create one of the biggest players in the luxury beauty sector, really create a challenger for L'Oreal, which is currently the biggest player in that industry. And this is a deal that also comes at a time when, we've got concerns about supply chain, around inflation, around consumer sentiment, and so those companies are really trying to find scale, and so we'll be watching out at the open for any market reaction there. And finally, Lufthansa is also in focus today. We saw the shares really rallying yesterday because of this optimism around the potential end to the war in Iran. But then today we have Morgan Stanley cutting the price target for Lufthansa, saying that there's continued risk of fuel costs staying higher for longer. And we have a separate note as well from Bloomberg Intelligence saying that those fuel hedges do not guarantee product delivery, and so those carriers are really vulnerable to those supply shocks. So we could see Lufthansa moving lower this morning.
Chloe, thank you very much. Chloe Melly with the movers. And on the subject of aviation, we just getting a headline on the Bloomberg terminal says Air France-KLM has submitted a non-binding offer for a stake in TAP, referred to as both things, at the Portuguese airline. And I spoke, Lizzy, to the finance minister of Portugal, who said even with everything that's going on in the world and the trouble that aviation is in, he was confident there would be bids, and there may still be more bids. OK, well, 5 minutes away from the open, we are negative on European futures. Euro Stoxx 50 futures down 1.8%, less bad for London as we see oil prices climbing. Stay with us, this is Bloomberg. Welcome back, everybody. This is the opening trade. A few minutes to go then until cash equities get started for Europe for Thursday. Feels like a Friday, but it is a Thursday, and the market sentiment maybe doesn't have a very much of a Friday feel. Let's have a look at the setup then going into today. This is a bit backward looking because this is the US session of yesterday, but I think it's still instructive of the volatility and the changing news lines, the headline risk that we suffer in markets right now. This was the optimism at the start of the trading day in the US yesterday. This is where Europe closed. That optimism continued, was challenged and then reinstated later in the session as the market positioned itself for something that seemed as if it was going to be quite positive, maybe de-escalatory from President Trump when he spoke overnight. We got to President Trump's speech and it was not de-escalatory, emphasis on the attacks that could take place in the next 2 to 3 weeks. And so the markets are caught in a negative reaction function today. So we see Euro Stoxx 50 futures, Lizzy, down by 1.8%. Perhaps the FTSE is a little cushioned, but we are expecting negativity wholesale across these markets today.
Well, let's take a look under the hood. Some of the stocks we're watching this morning include Novo Nordisk, likely under pressure after Eli Lilly's weight loss pill won US approval. Novo, of course, launched its own obesity pill earlier on this year. And indeed, Novo Nordisk's ADRs have been down as much as 2.5%. So we watch them at the European Open. Also watching Puig, Estee Lauder and Spain's Puig advancing in talks to combine, this according to sources, and the respective owners. There are the respective owners of Mac and Labo, so we'll watch that one carefully. Also, finally, Lufthansa. Airlines in general under pressure from higher oil and jet fuel prices, particularly after President Trump's speech. You would expect that to factor in. But indeed, Lufthansa downgraded at Morgan Stanley for precisely this reason, Anna.
Yeah, absolutely. A lot of focus on aviation then because of the broader story around oil and Iran. We've also got a bidding battle taking place, or maybe it will be a bid battle, certainly bids coming in for TAP over in Portugal. So the start of the equity trading session is expected to be negative. We're factoring in further risk of escalation in the Gulf. No new news lines surrounding the Strait of Hormuz. No new developments as far as reopening the Strait of Hormuz and trying to normalise energy markets. As a result of that, the oil price is higher. Stocks are lower. We're certainly seeing that the case this morning here in Europe, and US futures continue to point substantially lower. So the extent of the selling here in Europe, yes, the FTSE 100 is a little cushioned from it. That probably to do with energy stocks. But the FTSE is down still by 0.6%. The CAC 40 down by 1.3%. So overall, for these European equity markets, we're down by just over 1%. And we see the message from the Trump administration really oscillating day after day in terms of escalation and de-escalation. And the market's just sort of caught in its headlights, trying to disentangle all of the messaging and try and work out if any off-ramps are going to creep into sight. Lizzy, what do you see in the markets this morning?
Well, the FTSE 100, of course, will be boosted by energy. That is the best performing sector this morning. It's up 1.5%, but it's going to be dragged down by basic resources, and that's second to bottom of the sectoral basket, down 2.25%. Overall, you've got all but 3 sectors in negative territory this morning, reflecting that risk-off mood that you've flagged for us, Anna. Tech at the bottom of the basket, though, down 2.3%. Only energy, food, beverages and tobacco and personal consumer goods managing to eke out gains at the moment. But just recapping some of those stocks that we had flagged we should be watching, if we turn to the airline sector, if I can find it this morning, IAG's down 3%. Air France, despite submitting that non-binding offer for a stake in TAP, Air France shares down 4.6%. We're waiting for Lufthansa to open at the moment, and yeah, those are just some of those that are moving at the moment.
Yeah, absolutely. So delving deeper into the aviation sector seems sensible today when you've got oil prices up by 6.6%. 107.86 is where we trade on Brent, and sure, they can hedge, but usually that just smooths the edges of their exposure and the profile of energy prices rather than really wholesale reducing the exposure. So broadly in markets there, nearly every sector in negative territory, just energy stocks, food, beverage and tobacco actually proving a little more resilient today, which in itself is quite interesting, something we'll get to in a moment. Let's speak to Frédéric Carrier, who is Head of Investment Strategy for UK and Asia at RBC Wealth Management, with us on set this Thursday morning. Frédéric, thank you for being with us. So, I mean, let's take stock of where we are. European equity markets down substantially today, more oscillation in our expectations of escalation, de-escalation, but also following a pattern that we see most weeks since the start of this war, where the beginning of the week is more optimistic than the end. So what do you make of today's moves then, Frédéric?
There's a lot of focus about what President Trump, what the US might or might not do, but really what we focus on is the damage to infrastructure. And we see, while there are many scenarios as to how the war might continue or evolve, there's very few scenarios in which there is a normalization of energy flows because of the infrastructure damage. When you have the CEO of the Kuwait Petroleum Company saying that even if hostilities end today, it's going to take up to 4 months to put production back to capacity, you can just imagine what might be the case in Iraq, a larger producer with an infrastructure which has been underinvested. So we think that we have a scenario very likely of higher oil prices for much longer than what the market might be thinking.
Yes, Frédéric, can I ask you about where are opportunities in this environment, if it's possible to find them, or relative opportunities? Defensives, often useful place to think about, defensive stocks, a useful place to think about in times like this. But have they been playing the role you would expect? I noticed food and beverage, tobacco up today. It's mostly driven by tobacco, it seems. But this is the kind of sector that you might expect to do okay in tough times. What are you expecting?
So we have seen utilities do particularly well. Perhaps they are seen as halo assets, so unlikely to be disrupted by AI. They also will benefit from higher energy costs, so that sort of defensive is working. With respect to defense stocks, we think that the Iran war have unveiled perhaps some concerns which weren't there before the war. So the fact that Iraq within the first week was able to destroy a US radar facility, that suggests that perhaps the US deficit is not as advanced as we thought. Also, the economics of using very expensive air defense to shoot down very cheap drones. So the economic logic might be a little bit strained. So we've seen a derating of defensive stocks from 35 times forward earnings to 28 times. We don't think that they will go back there in a hurry. They should be trading at a higher valuation than in the past because there's more visibility. Countries will definitely increase their budget in defense, but we don't think we're going to see the euphoria about defense stocks as we've seen in the past. But
does that not just mean that you need to be more selective within defense stocks and turn from, tanks and ammo to air defense?
A lot more selectivity, yes.
Okay. Also, what counts as a diversifier when it comes to commodities? We've talked so much about oil, but, everything's being driven by this same macro shock. So how do you pick?
We talked a lot about oil this month. In January, we talked a lot about with gold. So we want commodities to play a role in our portfolios, but we want them to be very uncorrelated to macro events, uncorrelated to stocks and bonds. So we have a long-short strategy which looks at the broad commodities market, so freight and agriculture, power companies, industrial materials, and focus really on demand and supply, dislocation, price misallocation, and that will give a ballast in the portfolio that just buying a long-only commodity will not give you.
You would think that everything is impacted, though, by the war, whether it's through fertilizer prices or aluminium prices. How do you find a commodity that isn't touched by that?
So they all are, but it's all about demand and supply dislocations.
Yeah. I can ask about equities with a longer term horizon. I think with a 1 year view, you're still constructive on stocks. Talk us through that. How much of that is dependent on resolution of the current war? And also, is it reliant on the AI theme, private credit, keep on rolling in a sort of benign or positive direction?
So the key factor is that we believe that it's very unlikely that there will be a US recession. The US is independent in terms of food and energy. 20% of household incomes come from social security transfers, which are indexed to inflation. It's one of the highest proportion in history. So that makes for a very resilient economy. And of course, the AI investments are very important. So if the US does not fall into a recession, we think that it's warrant to be constructive on a 1 year view. Having said that, we know that in the past, when there's been a constraint on oil supplies from Middle East crisis, stock market have fallen on average by 16%. And when we've had growth scares, so instances where fears of recession start to be discounted in markets, but a recession does not materialize. In those episodes, the S&P 500 can fall between 14 and 19% over a period of 2 to 9 months. So that gives us a ballpark of the volatility we can expect over the next year.
I did want to ask you a question that I've been thinking of since we were last speaking to our FX guest earlier in the programme, and that is a result of the war that the dollar kind of loses purchase because more oil won't be traded in dollars because of this war?
So with respect to the US dollar, we think that the theme of an erosion of the US dollar will continue, but perhaps not to the same velocity as it had before the war. And certainly there are increasing number of transactions which are done outside of the US dollar.
Yes, because I suppose there's another view that maybe this show of force and show of power, this was what maybe the US administration might hope, that would help to support the dollar. Certainly in the short term, the dollar is well bid, isn't it? Yes. Let's talk about bond markets and what role they're playing at the moment, Frédéric. We've got bond yields are going higher once again, another sell-off, and that's in keeping with the pattern of trading in other assets that we would expect this morning. What role do you expect bonds to play?
So you were asking about opportunities in this market, and whereas it's difficult to see opportunities at the moment in equities because the headline risk is so high, we do see opportunities in the rates market in particular, and gilts for us have shown this opportunity. We've increased duration. We believe that the market is very much focused on the inflation impact of the shock, but we think that the Bank of England will have to flip very quickly to the growth impact. We're not in a situation as we were in 2022. Monetary policy is already restrictive. There's already a sizable output gap which keeps on growing. And so we think that the Bank of England, again, will be constrained in terms of increasing interest rates. And we think that when market discounts 3 or 2.5 interest rate increases over the year, we think it's too much. So we've increased duration.
OK, well, 10-year gilt yields up 6 basis points this morning at 4.89. Frédéric Carrier, Head of Investment Strategy for UK and Asia at RBC Wealth Management. Thank you very much. Well, let's check in on the core six this morning. How are they holding up in this risk-off environment? Oh, we do seem to have gains for Novo Nordisk and Nestlé. We had flagged that we should keep an eye on Novo Nordisk, given that Eli Lilly's obesity pill has won US approval, not under the pressure that we had been expecting, and despite the fact that ADRs had been down in the US for Novo. Also, Nestlé eking out gains of 0.2%, but losses for LVMH, Rheinmetall, ASML and Schneider. Let's take a look at some of the other individual stocks on the move this morning with Bloomberg's Chloe Melly. Chloe.
Good morning, Lizzy. Well, we are seeing those oil majors that were down yesterday now up, now very much in the green. And that is because yesterday they were down because of this optimism that the war in Iran might end. But then yesterday's comments from Trump about hitting Iran extremely hard over the next 2 to 3 weeks, that has led the market to think that maybe the resolution to the conflict is not coming just yet. And therefore, we are seeing oil gain and those oil majors gaining this morning, with BP in particular up 3%. Part of the same story is, of course, airlines, which are all down this morning after being up yesterday because of those higher fuel costs. And then we have some individual stories within that industry as well. We've got Lufthansa being downgraded and having its price target cut by Morgan Stanley because of this concern that fuel costs could stay higher for longer. And then we also have Air France, which has just submitted a non-binding offer for a stake in Portuguese carrier TAP. And so this is essentially kicking off the race for that company. And we are seeing just overall that industry down in the red this morning. Miners are also down. We are seeing Anglo-American, Glencore, Fresnillo, Rio Tinto all as well in the red. This is part of the same story, those comments from Trump. And finally, AkzoNobel, the paint maker, is also down after being downgraded by Goldman. And this is really part of that chemical sector that is really struggling with those higher input costs. And so we are seeing that downgrade really hit the stock this morning, down about 3.5% for that company.
Chloe, thank you. Bloomberg's Chloe Melly with those movers for you. Coming up on the programme, oil jumps then as President Trump's address dims hopes of a quick end to the Iran war. More on that next. This is Bloomberg.
Welcome back to the opening trade. We're 15 minutes into today's session and it is risk off here in Europe. Stock 600 down 1.2% on the latest from President Trump. We had that 2 a.m. UK time address from the president, essentially saying that he's planning to escalate to de-escalate in this war in Iran. And so the mood in markets is one of negativity this Thursday, as we have been seeing throughout the conflict. Weeks starting more positive than they tend to have ended. But particular weakness this morning coming from the DAX in Frankfurt. I should note that Denmark is closed today. So, in fact, Novo Nordisk is not trading at the moment. But what is on the move is Puig, as we have had the news that Estee, Lauder and Spain's Puig are advancing discussions to combine their businesses, a move that would create one of the world's largest luxury beauty players. For more, let's speak to our Bloomberg Deals reporter, Manuel Baigorri. Manuel, good morning. What more do we know about the deal?
Yes, Lizzy, more progress coming on this transaction as the companies are advancing on their negotiations. As we learned towards the end of last month, the companies were in talks to combine, potentially creating one of the biggest luxury beauty brands in the world. Lauder, obviously almost 3 times the size of Puig, which has a market valuation of around $11 billion. And talks between the companies are definitely progressing in the right direction. Most likely this is going to be a stock transaction, which will allow the two families behind the companies to remain in very active position and have a say in the combined entity. So definitely a very transformative deal in the consumer retail space.
Yes, Manuel, talk to us about the wider industry, the wider sector, and how this changes the competitive landscape.
Anna, I mean, for a while we've seen a significant uptick in transactions in what had been actually over the years a rather sleepy sector for big transformative deals. We saw just a few days ago the Unilever McCormick more in the food space. That was also a very large transaction. Obviously now this into the beauty segment, and Puig, which by the way just until not that long ago was a relatively not very well known privately held Spanish company from the northeast. then they did the IPO, and now people kind of realize, well, this company is actually rather sizable. I mean, they are very big, particularly in the fragrances segment. This will obviously, combining with Estee Lauder, create a potential rather steep competitor against the likes of L'Oreal, and definitely a big transaction in this space. I mean, remains to be seen how the two companies come together. All sources seem to indicate that it's perhaps a matter of a few more weeks of negotiations as they go through the SPA, and we may likely see an agreement on the table rather soon. As I mentioned earlier, most likely a stock transaction that will allow the two families to have a say in the company.
Manuel, thank you very much. Manuel Bagori, Bloomberg Deals reporter, with the latest on the consolidation that could take place within the beauty sector. Let's move on to another sector that is very noteworthy and newsworthy this morning. We see oil prices are higher. Let's talk about oil and gas jumping after President Trump, in his address to the nation, signalled an escalation to the war in Iran. He also called on the rest of the world to reopen the Strait of Hormuz, urging them to take the lead in protecting global energy shipments. For more, let's bring in Bloomberg's Middle East energy reporter, Anthony De Paula. It's interesting that once again we're seeing movement, of course, higher in oil, higher in gas prices, higher in refined product, Anthony, and another reminder that it is refined product that sometimes moves more on these kind of headlines. Europe and Asia, for example, reliant on the Persian Gulf for some of that refined product.
Yeah, good morning, Anna. Yeah, for sure, we did not see the markets calmed by the comments from President Trump this morning. He did say that negotiations and talks were still going on. He did express his thoughts that this, as he said, a changed regime is more reasonable than the last. Of course, we've got a Supreme Leader with the same last name as the previous Supreme Leader, and the IRGC military complex still in charge there. And then Trump continued with the threats particularly against the power plants in Iran. If a deal isn't reached, he is threatened again to bomb those. And then he made those comments that the U.S. would continue to monitor by satellite the nuclear sites and continue to potentially attack those. So that kind of gives the markets a view of escalation here. So that's why we're not really seeing much relaxation, and really no sign that the U.S. is going to work towards opening up Hormuz. And of course, it's that strait through which about a fifth of global oil demand passes each day under normal circumstances, that is blocked and cut off. And that's really what's starving the market of crude oil to go into those refineries. And so those refineries are not able to produce the products that they need to get to market. Plus, the Gulf region is a huge exporting market. So the Gulf refineries are also not able to get the diesel and jet fuel that they need to sell in the market. They're not able to get that out of the Gulf. So that's also a huge dislocation for the market, Anna.
Interesting to see China telling private refiners to keep fuel production at 2025 levels, Anthony, even if they have to incur economic losses a month into this war, a month or so. Who is it that's managing to get oil through the strait, if anyone, at this point?
Yeah, at the moment, we are seeing that Iran is letting some of its own vessels go through. It's charging tolls to let some other countries' vessels through. So, for example, we've seen Pakistan get a number of ships through. We've got a story on The Wire today talking about how Pakistan has offered its flag to some vessels for them to transit through Hormuz. But really, what we're talking about is those tankers that are inside the Gulf and getting out. We've got a number of tankers still in there that loaded up, haven't been able to get out of the Gulf. We're not really talking about tankers going in and trying to load and continue that normal trade. And it's Iran as well getting some of its oil out, still loading at Karg Island. Trump continues to talk about Karg as a key point for Iran. But they are able to load there and get their oil out through the Strait of Hormuz. So there is that trickle, but for all intents and purposes, for the normal working of the market, Hormuz is closed, and that massive supply is not coming out of the Gulf, Lizzy.
Anthony, thank you very much. That's Bloomberg's Middle East energy reporter, Anthony De Paula. Well, overnight, of course, there were two big things we were watching, President Trump's address and the Artemis 2 launch. NASA astronauts blasting off on a 10-day mission around the moon, marking humanity's return to the lunar neighbourhood for the first time in more than 50 years. The US and China are racing to put humans back on the moon, with NASA working to build a lunar base. Bloomberg Tech co-anchor Ed Ludlow has been reporting from the Kennedy Space Center in Florida.
4, 3, 2, 1. Booster ignition.
That was the moment that NASA sent astronauts back toward the moon for the first time in more than 50 years. Artemis 2 is a dress rehearsal, first for NASA's Space Launch System, or SLS, developed by Boeing, which generated almost 9 million pounds of thrust when it lifted off from Kennedy Space Center, Launch Complex 39B, here in Florida. Initially, there's this 2-day orbit of the Earth at different altitudes, practicing burns, practicing manual control of the Orion spacecraft before a translunar injection. That then puts the crew on a slingshot around the far side of the moon. 250,000 miles of distance, a total round trip of 685,000 miles, at one point 4,000 miles from the moon's surface. And in that time, the crew on board are going to be practicing maneuvers, manual control of the spacecraft, communication systems, emergency procedures, because Artemis 2 is just one step in a bigger picture plan to return astronauts to the moon's surface, potentially as soon as 2028. That is America and NASA's goal. And it's been an expensive enterprise, $4 billion per launch, a $93 billion program cost. And it's a race against China, who have their own ambitions to land on the moon. They've stated 2030. The crew of Artemis 2 are expected to splash down on the west coast of the United States in 10 days' time. This is Ed Ludlow for Bloomberg News at Kennedy Space Center in Florida.
Ed Ludlow on the ground for us then in Florida, keeping things and travel a little closer to Earth. Let's have a look at where we are on the aviation stocks, because clearly with oil prices moving as much as they are, you would expect to see some negativity coming through on the aviation space. So we've got oil prices are up by 6.6%. That's the Brent price. And as a result, you see Lufthansa, EasyJet, IAG and Air France all down by more than 2%. Of course, there will be hedging, as we said earlier, Lizzy, involved here to try and take the edge off. But really, that's what hedging does, takes the edge off. It doesn't protect you from fundamental, more medium-term changes in pricing.
Yeah, Lufthansa down in particular, 3.8% because of that downgrade by Morgan Stanley. But it comes back to the same reason everybody's down today, which is the higher jet fuel price. We should also flag Air France. It has that bit of M&A news. So Air France-KLM submitting that non-binding offer for a stake in TAP, the Portuguese airline.
Coming up on the programme then, we will talk travel and tourism. We'll talk to Irene Hayes, owner and chair of the UK's biggest travel agency, that's Hayes Travel, about the disruption to travel that's been caused by war in the Middle East. It's such an important region for transport through and also visiting the area itself, of course. We'll get to that next. This is Bloomberg. This is the opening trade, 30 minutes into today's session, and this is a look at these markets for you. We're negative across European equity markets, down by around 1.1% on the Stocks Europe 600, and we're only cushioned really because of the presence of big energy names, particularly in London, which is why London is not down quite so much, but elsewhere also. That is one of the sectors not doing too badly. Interesting that food, beverage and tobacco playing something of a defensive role today. That has not always been the case on days of negativity attached to war in the Persian Gulf. But this is the broad picture. And Lizzy, our colleagues in Bloomberg News have been writing about this phenomenon where we see optimism in the markets at the beginning of the week, more negativity at the end of the week, which makes sense going into any weekend, but especially a long weekend.
Indeed, and perhaps that is the reason that we've got such lower volumes today, down 34%. Also, of course, because we've had such mixed messages out of the White House, not just at 2 a.m. London time this morning in the President's address, but throughout this war. And as a mark of the risk on sentiment that you were seeing, we have 445 members of the Stock 600 lower this morning compared to 106 to the upside. But let's pick out some of the winners and losers, shall we? The leaders today include BP. As you say, we're seeing energy stocks outperforming, Brent edging higher off the back of President Trump's speech. So BP up more than 3 3%. Total up 2%. Same story. Energy really among the few outperformers in the Stock 600 today. But also in the retail space, we've got B&M doing pretty well after getting rated new buy at Kepler Chevreux. So B&M up 5.5% this morning. Flipping over to the laggards, because there are more of them than leaders today. ASML is one of them, down 4.6% after a 6% gain yesterday, mind you. But tech stocks overall dropping. Tech really in the middle of the turmoil because of the war, also with the memory and storage companies, especially Puig. We've got Siemens Energy down 4.25% after a gain as well yesterday. But this on President Trump's escalatory remarks. This is a company with big exposure to the Middle East, mind you. And Lufthansa, we flagged this for you. Airlines in general suffering today, but Lufthansa downgraded by Morgan Stanley on the risk that fuel costs could prove materially higher for longer because of the conflict, and therefore Lufthansa shares down 4.3%, Anna.
Those are the markets. Let's get an update on some of the top stories we're covering this morning. Oil prices jumping after President Trump vowed an escalation to the war in Iran over the coming weeks. During a rare primetime address to the nation, President Trump said the US military would hit Iran, quote, extremely hard. His comments dampening hopes of a swift resolution to the conflict, which has disrupted energy flows, with the vital Strait of Hormuz still effectively shut. NASA's Artemis 2 mission has launched to space and reached a stable orbit, kicking off a landmark journey that will take the crew of astronauts closer to the lunar surface than anyone has been in more than 50 years. The rocket system, taller than the Statue of Liberty, reached speeds of more than 17,000 miles per hour as it hurtled to space. The crew will spend roughly 4 days travelling to the lunar vicinity, where they will swing behind the moon's far side and be out of touch with Earth for a time. Lizzy.
Well, one of Europe's biggest airline groups has kicked off the race for TAP, with Air France-KLM submitting the first known bid for a stake in the Portuguese flag carrier. That non-binding offer was lodged this morning ahead of an end-of-day government deadline. Portugal looking to sell as much as 49.9% of the airline. Air France-KLM, Lufthansa and IAG were all invited to submit preliminary offers for TAP last year. So that just some of the latest news coming from the airline sector. But more broadly, the Iran war is, of course, disrupting global aviation, with soaring jet fuel prices, airspace closures and widespread flight cancellations hitting airlines worldwide. This crisis now spreading from Asia to Europe as global fuel supplies reach critically low levels. Kate Duffy, our aerospace reporter, joins us now for more on set. And Kate, we do have airline and travel and leisure, I should say more broadly, one of the worst performing sectors today. What should we expect over the coming weeks?
Well, speaking to airlines and their CEOs, it's really still that we're unsure about what's going to happen over the next couple of weeks. They're taking each day as it comes. But what is certain is just price of tickets is definitely going to go up. And that's across the board. So in the US airlines don't hedge their oil. So they're more exposed to the higher oil prices across the board. In terms of in Europe, the airline CEOs have already warned that ticket prices are going to go up as well. And in Asia, it's a similar scenario too. But in the Middle East, the carriers there, they're still really struggling to get their planes off the ground. They're suffering from, closing airspaces because of the missiles flying. And also we've reported that Emirates, is basically flying empty planes back into the region, to Dubai in particular. So this kind of gives you a sense of the demand into the region at the moment that they're facing.
Yeah, absolutely. What about government responses here, Kate? Because anytime airlines are up against it, there'll be plenty of voices calling for tax reductions, and this is an industry that has attracted quite a bit of taxation in recent years. So what are we hearing in terms of the response from governments?
From governments, it's a sense, especially in Asia, potentially they're warning that planes could get grounded, that maybe airlines coming into the country can't refuel their planes because they want to hoard that jet fuel essentially for their own needs. We're hearing from airlines, especially Lufthansa this week, potentially they could ground their planes if the situation continues and fuel supply shortages wane. And Ryanair is also speaking to its fuel teams quite a lot and just keeping in touch with the situation. So it's definitely impacting airlines across the world.
Because we'd seen these comments that perhaps April will be okay, but things get real in May. Is that still the thinking?
Yeah, that is still the thinking, yeah. So there's still a bit of time. They're just waiting on the situation in the US as to what Trump says and does. But for now, May is when the impact could really show.
And Kate, despite all the turmoil, you've got Air France-KLM still finding time for some potential M&A, this bid for a stake in Portugal's TAP. Air France shares, I should say, down 4.25%. Is that a sign that investors don't like the sound of this, or is it just because everybody's down in airline today?
I think it's probably more the latter at the moment. So with the TAP bid, we've also got Lufthansa and IAG in the race as well. Although we did report that IAG is likely to abandon this deal, so it could be that just Lufthansa and Air France go for TAP in the end. We will find out today because obviously that's the deadline. But that will show in terms of investors' confidence as to what TAP means for these airlines.
All right, Kate, thanks for the update. That's Bloomberg's Kate Duffy, our aerospace reporter, of course. Well, broadening the conversation when it comes to travel, let's speak now to the owner and chair of the UK's biggest independent travel agency, Hays Travel. Irene Hayes joins us now. Irene, thank you for making time for us this morning. So it was quite a bleak picture that Kate just painted for us. How would you say that bookings are shifting in the wake of the war? Are people actually cancelling trips altogether?
Some people are. We're managing to save the sail in many instances, and travellers that would have been going through, say, Dubai or Doha to the east are switching to perhaps short-haul holidays to the Mediterranean. But people still want to take that holiday, and very often they're travelling for family events, say, across to Australia. And we are just having to divert wherever we can. But yes, there's major disruption. And now that we have a full month, the month of March, and we've done all the analysis this week, overall we're down 10% as an average. But as you can imagine, the picture is very different in different parts of the world.
Well, this is quite a long-term question, but let's say that this war is protracted. Do you see other international hubs opening up that might replace the likes of Dubai and Doha?
I think that it's highly likely. I think that normally the travelling public have really quite a short memory, but the longer that this prevails, the more challenging it will be to find alternative routes, because other airlines cannot necessarily get airlift from all of the airports that they want to divert to. So it's challenging, not just as you discussed this morning around fuel charges, which could be one barrier, but the other barrier is their ability to divert and gain access to other airports. So yes, it will in the fullness of time have a longer and bigger impact.
Yeah, Irene, so it could bring about some big change. Let me ask you about the more near-term response then we're seeing from travellers, from customers. You mentioned that some are choosing to go short haul. Is it a sort of wholesale rejection of long haul, or are long haul journeys to, I don't know, the Caribbean and other places still intact?
Oh, yes, very much so. I think there are, without doubt, the Mediterranean resorts are the winners here. And we're seeing significant growth, particularly in Italy, Malta, Croatia and Spain. They are all significantly up for us. But to the other part of your question, people are still wanting to travel long haul. And the winners there are Japan, Australia, South Africa and Canada. As you may imagine, the current issue has had an adverse impact on America, and travel to America is down 32% compared to the same month last year, as are some, smaller destinations in Europe, such as Turkey. That's down, and as you would expect, Cyprus. But no, it's a mixed picture, and people still want to travel long haul.
OK, so people still do want to travel, down 10% as a sort of broad average. That's interesting, that stat you gave us about America, Irene, being down 32% year on year for the month. I mean, what was the picture like before this war? Because anecdotally, we'd heard that there were fewer people wanting to go from Europe to America, perhaps linked to the politics. But you tell us what you're seeing, what you've been seeing in your bookings.
Okay. Yes, we've seen a downturn in America before the 28th of February when the Ayatollah was killed, and the period of the war had not then properly begun. So we'd seen a downturn in months before that, but nothing as severe as 32%. So we would have seen figures coming through of about 10 or 11% reduction. But there is still a lot of confidence in some parts of America. So Florida, understandably, with the investment that's just gone in from people such as Universal, has seen an increase, and New York and Vegas have seen a significant decrease, as have other parts of the states. But the Sunshine States are still holding up, but not doing as well as they were previously.
And Irene, given the soaring cost of jet fuel, is it that people are opting for train travel instead? I've always fancied the Orient Express.
Train travel was increasing anyway because touring in general is increasing, and there are lots of new rail products coming onto the market. But it really doesn't have the capacity to take all of the slack from the airlines that are having challenges from airlift and fuel price problems. So yes, trains and touring's doing well. But people are in the main just seeking out alternative routes. You've talked about Lufthansa this morning. Lufthansa is a real option out of the UK rather than going across to Dubai and hubs elsewhere, Schiphol in Amsterdam. So what we're trying to do wherever we can is just divert away from the main hubs. But when you consider that on a normal day, Dubai International Airport would carry about 325,000 passengers, either staying in Dubai or transiting onto places like the Maldives and Mauritius and India. It is really quite a challenge to divert that level of capacity away from east to find alternative routes.
Irene, thank you very much. Thanks for joining us. Good to get your perspective. Irene Hayes, owner and chair of Hayes Travel, giving us a bit of a deep dive into what we're seeing the impact looks like on the travel industry from war in the Middle East. Coming up on the programme then, it is 1 year since President Trump announced his Liberation Day tariffs. What's been the impact of that? We've had a reminder of how this story is not completely done just this morning. We'll bring you all the analysis next. This is Bloomberg.
Welcome back to the opening trade. 47 minutes into today's European session, and it's miserable in these equity markets. We already saw losses in the Asian session. We're set to see losses in the US session later, with the stock 600 for now down more than 1%. Particular losses out of Frankfurt for the DAX down 1.4%. The FTSE 100 somewhat cushioned by its exposure to energy, but that is the reason why we're risk off, because we have Brent up more than 6.4% at $107 a barrel this morning. WTI also above $100 a barrel off the back of President Trump's address at 2 a.m. this morning from the White House, essentially telling us that he wants to de-escalate this conflict in Iran, Anna.
Yeah, so we very much focus on the impact of war in the Middle East right now. This time last year, we were talking very much about trade. The Trump administration is said to be weighing new tariffs on drug makers and preparing to overhaul its steel and aluminium tariff policy. The moves come 1 year since President Trump announced his Liberation Day tariffs. Brendan Murray has been through the past year with us, Bloomberg's trade czar, and joins us now. Brendan, good morning. Let's start with the here and now. Tell us a bit more about what we have learned about drug makers and the investigations that have been taking place and the tariffs that might now follow.
Yeah, exactly. Both the steel and aluminum and the pharmaceutical tariffs are part of this national security investigations that the Trump administration has conducted over the past year. We're seeing now the 100% 10% tariff on drug makers if they're not producing the medicines in the U.S. or unless they've struck a deal with Trump. 9 of them did so at the end of last year. So this seems to be a move by the Trump administration to encourage those companies to follow through on those pledges. And if not, they're going to face a very steep 100% tariff.
And what's the point of the relook at steel and aluminium tariff policy? Is it simply simplification?
Yeah, I mean, the steel and aluminum tariffs last year got more complicated as the year progressed, and it became nearly impossible for a lot of companies to comply with them to try to determine the amount of steel or aluminum content in the product that they're importing. So the administration heard a lot of complaints, and they've said that they will respond to them, and this is the attempt to do so to try to make that process less burdensome to companies and their bottom line.
Okay, so importantly, it's more for businesses than to help out voters ahead of the elections.
Yeah, I mean, ultimately, that's who would feed the benefits would feed to. But at the moment, it's so difficult to figure out the content of products that contain those metals that companies are saying, look, we've thrown up our hands and we need some help. And so it sounds like the Trump administration is attempting to do that.
Yes, and can't start. Let's take us back a year then, Brendan, and think about how far we've come on the tariff journey over the past year. Because on the one hand, you can look at the effective tariff rate and say, look, it's 4 times where it was pre-Liberation Day. On the other hand, you can say it's much lower than it was around Liberation Day. What kind of story are you minded to tell about tariffs?
Yeah, exactly. I think the story of the past year was that Donald Trump's tariff bark, the bite was a lot less than the bark. And he came out a year ago today and said, I'm going to put tariffs, very high tariffs on the rest of the world. The markets reacted negatively to that. And what we wound up with was something a lot less burdensome to the economy. It was rolled out over many months. And so the economy had time to digest these higher costs that the president was imposing on American importers in a way that didn't crater the economy. And so what we're left with now is the president trying to rebuild a lot of that now that the Supreme Court has struck down the main tool that he was using. And now we're seeing these pharmaceutical tariffs, these reworked steel and aluminum tariffs, and we'll get more. There's another case coming on semiconductors. And imagine if you put a tariff on semiconductors and products containing semiconductors, you could hit a lot of imports that way. So we'll see how the president rolls those out in the weeks and months ahead.
Well, you're making my head spin with all of these changes that have been, could be in the future. Surely that uncertainty has its own cost economically.
Yeah, absolutely. That was the story all of last year, was the uncertainty, and the president tried to combat that all year long. And now what we're seeing is another round of that sort of uncertainty. If he has to undo the whole sort of tariff program and patch it together with all these different kinds of authorities that he's using, it's very hard for companies to know what they're going to be paying to import goods 3 to 6 months out. So what we're seeing is just another cloud, a different cloud of uncertainty hovering over the economy.
You talked about the contrast between the bark and the bite then in terms of tariff policy from the Trump administration, Brendan. What has this done then overall to flows of trade? Because it seems as if China is still finding markets for its products, just not so much to the US or not directly to the US.
Yeah, it seems that another lesson of the past year is that global trade is pretty resilient. Trade in goods was up 3 or 4% last year, which is above the sort of mediocre average that it has been over the past couple of decades. This year, obviously, we're looking at the war in the Middle East as another disruptive force that could suppress demand and bring that 3 to 4% rate down to something closer to 1.5 or 2 are some of the estimates that I'm seeing lately.
It's interesting because we had reported that cheaper Chinese goods might be one thing that helps to ease the Iran effect on UK inflation. Just something to bear in mind. Brendan, thank you very much. Our trade czar there, Brendan Murray. Well, let's recheck on these European stocks, shall we? As I say, it's been a bleak morning. Stock 600 down 1% at the moment. The FTSE down 0.2. The CAC 40 in Paris down 1%, but the DAX in Frankfurt down 1.4%. We can get a bit of analysis now with Morwenna Conium, who joins us from the Markets Today team. Morwenna, is this just a reversal of what we saw yesterday, or is it something more?
I mean, it is a reversal of what we saw yesterday, particularly if you look at the bond market. We saw in the UK some bonds having their best day in weeks. That's really unwinding today, but it's following on from the global trend set by the Fed from the US last night and the expectations for the Federal Reserve. That's flowed through Asia, and now we're seeing it very much in the European morning. It is something more in terms of the hope I think we've been building up to has been dispelled, and it really, I think the fact that we're just sort of back where we started, each incremental reversal, I think, slightly builds in terms of overall sentiment, how seriously they take the next sign of maybe some intention to move forward. I think the lack of a clear exit plan has weighed quite heavily on those who were hoping that this might be temporary, and that really ultimately is going to set into those inflation expectations and the worries about sort of second round effects and this actually being more protracted.
Yeah, I mean, Morwenna, when we look at stocks, our colleagues have been writing about how we're following a weekly pattern that looks quite similar week after week of this war, where there's optimism towards the start of the week, perhaps induced by certain types of headlines with some de-escalatory flavour from the US. And then by the end of the week, we are quite negative. And today certainly fits with that theme, doesn't it, as we watch another day of negativity for stocks, nearly all sectors.
Yeah, but it's very broad-based. It is risk-off driven. I think one of the only sectors that's really getting this morning is oil-linked stocks, particularly heavy losses for things like tech, miners, financials. It's very much as you'd expect. But, we're also seeing that sell-off in gold continue as well, because interest rates rising on bonds makes that less appealing. So it's one of those risk-off but also quite broad-based sell-offs, and it is. I mean, every region is behaving in a very similar way, and every asset class. So it's quite an interesting but quite depressing morning.
Okay, Morwenna, thank you very much. Bloomberg's Morwenna Conium from the Bloomberg Markets Today team. Time to talk about the weekend, Lizzy.
Yeah, well, we've got all the sports you could ever want. We've got the basketball, the rowing, the football, and of course it's Easter for the chocolate lovers.
Is that a sport? That is definitely the sport that will be practiced in my house, yes. Yeah, as I see, chocolate companies are trading higher today, something about resilience, defensiveness in tough times perhaps. 8:56 here in London, then the Pulse is up next. I'll be here with the next hour of trade. We'll continue to take you through these market moves this Thursday. This is Bloomberg.